Bond yields rising fast after that red-hot inflation report. The 10-year yield breaching 2%, the first time in more than 2 years.
We've seen 29 corrections since 1970. Only 7 of them turned into bear markets.
Normally, if you have a normal economy without too much debt and you can actually go through a recession without widespread insolvency, is it generally causes a recession, people consume less of it, and that helps equalize the market.
Welcome back to Wealthy Value. The US government has pushed a total of $9 trillion into the economy since the start of the pandemic. With tax dollars so desperately needed, the IRS is looking to crack down on cryptocurrency. But what if you could trade crypto tax-free? Here's how to do it in 60 seconds. Step 1. Open a crypto IRA account with our friends at iTrust Capital, the world's largest crypto IRA platform with over $3.5 billion in transactions, over 1,500 positive reviews on Trustpilot, and no monthly fees. Step 2. You can transfer your existing IRA, roll over your employer plan, or make a cash contribution through ACH transfer, bank wire, or check. Step 3. Start investing. Available assets include not just Bitcoin and Ethereum, but also Cardano, Chainlink, Polkadot, and all major cryptocurrencies, as well as physical gold and silver. No taxable events mean no complex tracking needed, and security is the best in the industry. All digital assets are held in offline cold storage with the leading institutional custodians, Curve and Coinbase Custody, which are both insured and backed by the largest venture capital firms in crypto. Use our link itrust.capital/value in the description below and get $100 in Bitcoin when you open and fund your account.
I think it's one of the tools that has a chance to, right? So I think that, and that's where we go back to, true hyperinflations or truly impoverished areas. Having access to liquid hard assets is really useful. Anyone paying attention to what happens in Venezuela, Turkey, Lebanon, any of these countries, Eastern Ukraine, where people are trying to flee out of that area, right? Having self-custodied hard money is really useful. And I think that's one of the things that people in the West missed or don't care about, is they think like, why do we need crypto? Why do we need Bitcoin? And it's like, well, you spent decades in a rather safe bubble that the majority of the world doesn't have access to. Most people, a lot of them don't even have access to good stock markets. A lot of them don't have, a lot of people can't afford a home. And so they need something hard to save in that's liquid. And it's volatile. One of the long-term potentials is that Bitcoin can be that thing. It can allow for uncensorable payments, and it can allow for difficult to confiscate savings. And so I do think that that's one of the technologies that can, demonetize. We've monetized all these assets like homes. Ideally, you want to demonetize these productive things and have actual money be monetized, right? Instead of bad money and then monetize everything else, you demonetize those things and have your actual money stored in money. And so I do think that's one of the most powerful tools that people have. Wealth concentration is a lot more complex than a lot of people make out to be. They often propose that there's just one thing. Like if we didn't have QE, then we wouldn't have wealth inequality, for example. Or I prefer the term wealth concentration usually, just because no one should expect wealth to be equal. It's only concerning when wealth is say unhealthily concentrated due to kind of bad policies, right? So I kind of tend to phrase it as a problem of wealth concentration. And I think that the big starting point is to make that there's so many moving parts, and some of it is unintuitive to a lot of the common narratives or sound bites that you hear, both inside the Bitcoin community and in the broader macro community. There's so many kind of takes out there that aren't necessarily backed up by data, and the actual underlying, all the mechanisms are actually really complex. And you can even consider Bitcoin as a type of populism, but I would just describe it as one of the better types of populism. Basically, it's people rallying behind a new network effect technology and saying that this is the solution. And so that's obviously the populism I would prefer, more so than some of these kind of other types of populism, right? So I think that I don't view populism in itself as a bad thing. I just view it as something that it starts, you have to, when it starts to develop, politicians have to pay attention to it. And if they don't, then you start to get these more dangerous varieties. Absolutely. And part of it, that goes back to Bitcoin and money, is that because we've had decades of bad money, weak money, right? So to zero near zero interest rates, and especially negative real interest rates, people have had to monetize other things. So they monetize stocks, they monetize real estate, they monetize all these other types of assets. And those, especially for real estate, which is among the most functional of assets, it puts them out of the reach of people. So if you look at, say, home values to income ratios, and this is not just America, this is around the world, it put that more out of the reach of people. My father, who he was pretty old when I was born. He was old enough he could have been my grandfather. And when he was like in his 20s, he was a police officer and he just bought a house. Like it wasn't a huge deal to buy a house. Whereas, decades later, someone who and he didn't have to get student debt to do that. He just kind of went in and worked and was able to buy a house. And now we've kind of made it so that, you need a degree often to have kind of a similar income that someone had decades ago without a degree. And yet you also have student loans and things are more expensive. And so that's kind of part of why people have kind of sensed that things are becoming more and more stacked against them. Yeah, absolutely. If you look at, so I've used kind of the 40s as my template for where we are in the 2020s. But if you look at the 2000s and the 2010s, that means those were the 1920s and 1930s. You kind of have this big parallel, and you can frame that in multiple ways. I like to frame it through the long-term debt cycle, right? So that's the last time that monetary and fiscal policy look like it does now. But it also looks very similar in terms of wealth concentration. That's the last time you had wealth that's concentrated in the U.S. And in some other countries. And yeah, you get prone to extremes, right? So you have kind of a spectrum of outcomes. On one hand, you can have like what happened in Russia, where you overthrow, the wealthy and then make it worse, right? You just kind of have that kind of revolution. You also, in another dark way, you have like the Nazis, right? You had the rise of that was one of the most dangerous forms of populism at the time. Or in the United States, because of our experience with World War I, we then did World War II a little differently in the sense that when say veterans came back from World War I, we kind of just gave them a bus ticket and said thanks for your service. And then that kind of that led into some of the things that the wealth concentration that happened throughout the 20s, and eventually kind of the breaking of the social contract. Whereas when we had veterans come back after World War II, we were like, okay, I mean, this is not where we're going to stop spending money now. So we're at least going to make sure that these veterans have resources to get integrated back into society, that we thank them for their service. And so we handle, obviously there's, different political opinions about the political leaders at the time, but we did kind of recognize that there was growing sympathy with communism in the country, right? There was, we were kind of in that kind of war of ideas with the Soviet Union, with kind of those more dangerous aspects. And we said, okay, we can't, obviously we don't want to go down that route, but we can't ignore some of these rising populist tendencies and these people noticing that the social contract's breaking down. So it's okay, how can we tweak policy to kind of address that? And right or wrong, they kind of threaded the needle enough that the United States kind of, partly because of the war outcome, but also just because we kept our kind of institutions relatively intact, we went on to have another several decades of prosperity. So it kind of is identifying the problems and then not ignoring them, right? But there's obviously different views on the best ways to solve those. Well, it's one of those things where I think it depends on where in history you are. If we imagine a sufficiently technical future where, say, 80% of the population just can't find a job, that's a very different discussion than what we have, say, right now, right? So I think, I think when you look far enough in the future, those types of things, I don't think someone's crazy for bringing those up and say, how are we going to manage this if we get to that future? And I know Andrew Yang likes to use he uses the example of Alaska, right? Because he likes to point out that it's not purely a left-leaning thing, right? So Alaska is a generally Republican state, and they had like an oil dividend to their people. Basically, that the people of Alaska in some way benefited from the fact that Alaska has oil, rather than just a couple companies coming out and them benefiting from it. Norway did a similar thing where they had these gigantic oil reserves, right? And instead of just having a company come in and just kind of get all the benefits, they said, no, this is the people of Norway's resources. And so they That's how they started their whole $1 trillion sovereign wealth fund. They started with oil profits, and they took those profits, they invested it. So now people in Norway have the equivalent of a gigantic pension. So they haven't gone the full UBI route, but basically they have a pension that represents the fact that they were lucky enough to be born in Norway, essentially, and that they had the very high kind of per capita allocation of natural resources. And instead of just all of that going to the kind of the oil barons, it went to essentially the people, at least on the behalf through the government as a proxy. And again, that's one of those things people can debate how that should go. So you can argue that when you have the natural resources or technological resources, that it's kind of the government's job to share those resources to maintain the social contract. But the risk is that if you do those in such a way that it destroys incentives or it damages incentives to work and to feel like you're part of the community, it can make it worse. So I think it's if you bring out those types of solutions too quickly, you make people too dependent on the government, you break down incentive structures, that's where you have a lot of danger. And that's also why I view it as less likely being in more of an inflation or stagflationary type of situation, where we already see that when you get high energy prices, some of these countries, they give people money to buy energy. So normally, if you have a normal economy without too much debt and you can actually go through a recession without widespread insolvency, what happens when oil prices get too high is it generally causes a recession. People consume less of it, and that helps equalize the market. So this whole kind of multi-decade credit growth, all of this, the whole fiat currency system is kind of like a shark that swims through water. A shark can't stop swimming, otherwise it drowns, ironically. It just has to keep swimming. It has to keep getting water through the gills in order to keep that going. And the fiat currency system is kind of like that, where this constant credit growth can't stop. It has to keep growing. And so when you get this indebted, this part of the long-term debt cycle, if you run into a recession, it starts to get more existential. It starts to get more kind of depression-like or just massive insolvency-like.